Aloha folks, thank you so much for checking out this video. If you are new to the channel, my name is Mark, Mr. Dividend Investor. In this video, we are going to talk about 3 stocks that can outperform in a recession, 3 stocks that you probably have already in your portfolio, 3 stocks that many people go and purchase every day, whether you're a investor or not. I think these are companies that a lot of people use, and based on Wall Street analysis, they all have at least 11% upside. So if you're interested in what are these companies, sit back, enjoy it. Please do me a favor, hit that like button. If you're not yet a subscriber, please subscribe, hit that notification bell so you don't miss out on any videos that I put out. Without any more delays, let's take a look at this company. So the company is, first one is Walmart. The ticker symbol is WMT. This is a company that engages in retail and wholesale business. So you probably already shop in this store. I do a lot of shopping here. I find a lot of great products. Use this company very often, in my opinion. It's like a one-stop shop for me, in my opinion. You can get pretty much anything at Walmart. Let's take a quick look at TipRanks. Based on TipRanks, price target is at 151 with a 14% upside. At the time of this video is at 133. 12-month forecast rated as a high of 170, an average of 151, and a low of 110, with the analysis rating of moderate buy, 22 ratings, 17 buy, 6 hold, and 0 sell. If you look at the analysis, based on the analysis, they have a smart score of 8, which is outperform. Hedge fund holdings have increased, and then there's a strong buy and bullish sentiment. So if we go to simply safe dividend, based on their dividend safety score, they rate it as a 90, which is very safe. The dividend yield is 1.68, and then this is a mega cap of 362 billion. Let's go look at the key metrics. Payout ratio is 37%. Forward PE ratio is about 36. And then during the recession, they haven't increased it. Looking at the dividend growth, the last 5 years has been very slow with only 2%. Last 20 years, 11%, which is fast. You can see from here that uninterrupted dividend streak of 48 years without a reduction, growth of 48 years consecutive increases, which is pretty solid. If you look at it, it was going up, and then from 2014, it kind of slowly stagnant, but then looks like it's going up this way, so which is good. Your payout details: get paid quarterly in the months of January, April, May, and September. Your annual payout will be $2.24 per share, which breaks down to about 56 cents per quarterly. If you look at the dividend yield, you can see it is in the under the 5-year one. PE ratio is about 21. Consumer staples is 20. And then if you look down a little bit more, you can see the free cash flow payout ratio right here. Looking on the sales growth, you can see here, and then investment return on investment capital 14%, return on equity 16%. Let's swing over to bar chart. Based on their technical opinion, they figure this is a weak sell. Like if we look down further, you can see based on their analysis, there's a moderate buy, 25 of them. You got 15 strong buy, 3 moderate buy, and 7 holds. Now, if we look down further down, you can see some of the key turning point key points. So you can see first support level is about 131, second support is 129, and third support level is about 128, and then your resistance points are right here. Okay. Now, if we swing to simply Wall Street, looking at their share price versus fair value, their fair value is about 211. Currently is about 133. They calculated this using their discount cash flow model. to about 36% undervalued. Now, if we go to some of the positives, trading at 36% below value, earnings to forecast to grow 8% per year, earnings grew 38%. Risk analysis dividend of once is not well covered. So, not sure about that, but okay. Let's take a look at the next one. So the next one I want to talk about is McDonald's. The ticker symbol is MCD. This is a company that engages in the operation and franchising of restaurants. So another solid company that I say many people go and purchase their products. I go all the time to this one. They have some great french fries too, and they also have this great app. So if you're going to McDonald's and you haven't downloaded the app, might want to check it out and see. You got some free things in there. So let's take a look at TipRanks. At the time of this video, it's at 254. Analysis rating a strong buy, 22 of them, 19 buy, 3 holds, and 0 sell. The price target is about 284 with 11% upside. 12-month forecast rated as a high of 320, as you can see from here. Average about 284 and then 250. If you go to the stock analysis, you can see Smart Score outperform. Hedge fund holdings have decreased. And then now, let's take a look at Simply Safe Dividend. Simply Safe Dividend rated as safe, 77, dividend safety score. Dividend yield is 2.17. It is another mega cap of 188 billion. Let's look at the key metrics and the dividend growth. Payout ratio is about 55. Forward PE ratio is about 55. Another one that I look at is recession. They have increased. Dividend growth, you can see the last 20 years, 17%, which is very fast. Last 5 years, 8%, which is fast, and then you got your average. Now, if you look at the chart, you can see nice upward trend. 45 years without a reduction, 45 years of consecutive increases. So pretty solid in my opinion. Payment details, quarterly in the months of March, June, September, and December, and your annual payout is $5.52 per share, which breaks down to about $1.38 per quarter. If you look down, as you can see, here's the 5-year average. There's the PE ratio. Sector PE ratio is right there. Now, if we look down to return on investment capital, 23% is right here. Return on equity, they have a negative 100. Now let's swing to bar chart and look at their price target. So pretty much their high is 320, and then the mean is 281, and then the low is 250, and then rating is moderate buy. You can see from here, breaking it down to currently, you can see 24, 8 holds, 13 strong buy, and 3 moderate buy. Swinging now over to Simply Wall Street based on share price and fair value. Fair value rates at 250, it currently is about 254, so you're overpaying it based on their discount of a 1% or basically 2%. Some of the overview, you can see high level of debt and then insider selling. But the good thing about it, pays a reliable dividend, and earnings are forecast to grow 12% per year. And the last company stock I want to talk about is Johnson & Johnson. Ticker symbol is J&J. This is a company that manufactures and sells products in the healthcare field. So another solid staple company. I love this company. I think this one is a must, in my opinion, to have in your portfolio. If we look at TipRanks, based on their price target is in 186, 11% upside. At the time of this video is a 167. 12-month forecast rates it at 201, average of 186, and then you got 173. analysis, moderate buys, 6 of them, 3 buys and 3 holds. Now, if you look at the smart score, 10 outperform. Hedge fund have increased their positions, and then you have moderate buy, bullish sentiment, and that. So swing over to bar chart based on their target of 215, 186, and then a low of 165. Moderate buy for the past couple of months. Currently, you can see 8 holds, 7 strong buy, and then 1 moderate buy. Now let's swing into Simply Safe Dividend, and then you can see dividend safety score 99, very safe. Dividend yield is 2.70. It is another mega cap. Key metrics, you can see payout ratio is 43, forward PE is 45. They have increased their dividends during a recession. Dividend growth, you can see 9% the last 20 years, 6% the last 5 years. And check this out, uninterrupted dividend streak of 106 years without a reduction, and then dividend growth streak of 59 years consecutively. Amazing. Payment details, you get paid quarterly, the months of March, June, September, and December. Payout annual of $4.52 per share, which breaks down to about $1.13 per quarterly. Yeah, and then you got your dividend yield right here, sales growth, investment return on investment capital 22%, return on equity of 25%. Last, Simply Wall Street, based on share price and fair value. Fair value, they feel is about 228. Currently is about 167. Calculated about 26% undervalued. So, all right, those are the 3 stocks that, in my opinion, outperformed in a recession. I think those are great companies that many people, it doesn't matter what season, recession or not, people are still going to continue to purchase and use their products. So thank you so much for watching. Hope you like this video. Please remember that this is not financial advice, this is just me sharing. There are also other videos that you can take a look at if you like. Thank you so much for watching, guys. Stay cool, keep investing, and I'll catch you guys in the next video, right? Take care. Aloha.